Hi everyone, welcome to Market Monday Picks on the 4th of November. I'm Jarek Seed. It seems to be risk on again on the month of November, with the US inching higher last Friday. However, all eyes will be on the election coming on Tuesday, and that will likely dictate how markets move going forward. So first, we have Hussaini, who will share with us the ongoings of the local telco space. Hussaini, welcome later. And then I'll also share about the updates of my recent NDR with MPM to KL, as well as an overview on the Aztech's 3Q results recently, and also CSE's latest order book update this morning. Lastly, we have Amiru, our chart guy, who has two technicals on his sleeves. Stay tuned to find out. And now, let's start with Hussaini. Hi, Hussaini. Can you share more about the competition on the local scene within the mobile and fixed broadband space?
Yeah, sure. Thanks, Jarek, and thanks for having me. Good afternoon, everyone. See, competition in Singapore mobile and fixed broadband space remains elevated, especially in the lower end of the market. See, Singapore is a very crowded and a saturated market. Uh, it has four mobile operators and more than 10 MVNOs, which makes it very, very crowded. In terms of market share movement, it is quite surprising as well, with a very divergent trends. So if we see the last 9 to 12 months trend, Singtel and Simba, which is number four operator, has gained market share, while Starhub and M1 has lost market share. So if we see the last semester trends, Simba posted 36% year-on-year revenue growth, whereas M1 and StarHub revenues declined by mid to high single digit, and Singtel posted a decent 6% growth. See, Simba is operating in a mid to lower end of the market with relatively cheap and simple products in the range of $10 to $12. And this is the space where M1 has a bigger presence and StarHub also has a decent presence. And that's where we think Simba is inflecting pain.
Thanks, Hussaini. Sure. Then next, will Simba be able to take market share from the current competitors? And why do you think so if they are able to?
Yes, we think Simba should be able to continue to inflict pain or take market share. So if you look at figure 4 and 6 of the report, we see Simba's mobile and fixed broadband plans are 30 to 50%, a 30 to 50% discount to the incumbents, which means there is risk that Simba can continue to take market share from the incumbents. Also to note is Simba's operational and financial standing. Simba has around 5% market share, revenue market share. And even with that small market share and and the competition which is elevated, they are able to attain 42% EBITDA margin, which in our view is quite encouraging. They are also free cash flow positive. They turned free cash flow positive in the last semester, and they own a very strong on net cash balance sheet. So that also puts them in a strong position to continue to take market share. So given these factors, i.e. Simba's discounted pricing and strong operational and financial standing, we don't think that they are going to stay at just 5% market share, and we are of the view that they will rather aim for a higher market share. Given this, we are of the view that even when the industry consolidate or the consolidation happens, effectiveness of it in improving competition would be limited.
That's interesting. Wow, I think the other local players have to be on their toes for Simba's incoming arrival. And I understand that, Singtel has always been your top pick, and the stock has actually did quite well since you are quite bullish on it and have a few buys on it. But can you share more on why are you still bullish on Singtel, and also why the downgrade on Starhub?
Yeah, sure. So let me start with startup first. Uh, 41% of startups' revenues and even a higher proportion of its EBITDA comes from mobile and fixed broadband, where Simba is very active. Uh, with that, we think that these businesses of startup may remain under pressure. And factoring this, we trimmed our startup revenue, earnings, and target price by around 2 to 5%, and we have downgraded startup to hold. Now, moving on to Singtel. Singtel has a small exposure to domestic consumer business at around 10%, whereas the same for startup is 41%. So, uh, as such, Singtel is fair bit insulated. And also to note is that Singtel's consumer business is catering to mid to high end of the market, which also shields it from Simba's aggression, as Simba is focused on low to mid end of the market. And finally, we reiterate our buy on Singtel, where we see catalyst is means for us, where we see Singtel's catalyst. It is in Australia, which where it is improving revenues as well as cutting costs, as well as its data center businesses. And also on the associate side, Thailand, India, as well as Philippines are better placed. So Singtel fair bit insulated and have multiple catalysts in its bag.
Understood. So buy on Singtel, guys. Okay, thank you so much, Husaini.
Thank
Next,
you.
I'll turn our attention to KL for NDR and to meet Insti clients, and we have a few important key takeaways that we came back with. Firstly, it's on the CSOV delay. So the CSOV, I think that finally is going to be completed by the mid of January, and they will likely be sailed to Taiwan by on the 15th to 20th of January. And with that, I think it solved a lot of issues and also a lot of concerns on whether will there be further delays. And I think the risk of it, likelihood of it is actually quite pretty low. However, we do think that there might be some issues that will first arise in the first 6 months. It's like, when you build a new house, there will be certain issues like your flush issues or electrical wiring or appliances, minor issues, and that might cause some downtime. But we do not think it will be a big concern. It's just fixing some certain stuff and it should be smooth sailing by 2026. And most importantly, we do understand that the utilization for the first 2 years has already been almost fully booked out, and we expect utilization to be close to more than 85% for the first 2 years. And the rates are around averagely about $50,000 a day, and gross margins will likely be above or around 60%, which is very healthy. And we do think that this will provide a good burst for FY25 and more for FY26E, because for FY25, with the year end September, they only have about 6 to 8 months of contribution from the CSOV, and also but a full year contribution for FY26. And next, we do think that also the repair revenue, which actually dropped this year, will likely rebound next year, mainly because the CSOV delay, and that has resulted in a lot of manpower actually focusing on the CSOV. And with the CSOV now almost completed, the manpower has actually shifted back to the repair side. And this will actually allow repair volumes to rebound year on year. And next, also the dry dock 4, which is the expansion of the dry dock from 3 dry docks to 4 dry docks, will likely increase revenue capacity by 25% for the repair and maintenance segment. And that will allow, who should likely see with workers coming back as well, and they are recruiting more and training more, that will likely see repair volumes pick up next year for FY25. And the next also is that on the CTV side, they are likely going to pump up more CTVs for next year, which will likely add at least 1 or 2 more CTVs by the end of next year. And that will result in the CTV fleet increasing from 1 last year to 4 to 5 next year. Each CTV generates about $8,000 a day, and the margins are also close to above 60%. So with this, we do think that, profitability for Marco Polo should likely increase for the next 2 years, and more for FY26. But FY25 should also see a quite decent increase as well. So all in all, we do think that the outlook for Marco Polo seems to be quite positive now. with the risk of delays of any CSOB likelihood very low, and profitability should come in, in the next few quarters as we speak. And the upcoming results, we are also quite okay with it. We do think that it will likely hit our numbers or better, based on our channel checks. So we have a buy on Marco Polo and remains one of our top pick for the small mid-cap space. Next, we'll move on to Aztech. The performance for this recent 3Q revenue was quite disappointing, with revenue dipping about 41% year-on-year to 166.7 million. That was mainly due to orders from its key customer, which is Amazon, to actually decrease year-on-year. And that is mainly due to the product facing actually slower demand in the US. And the customer, or rather management, has also guided that going forward for the fourth quarter, it expects demand to also remain weak and weaker than 3Q. So with that, we actually downgrade to a hold. But the reason why you're not downgrading to a buy is because of its net cash balance sheet. Basically, they still have a lot of net cash. And after even lowering our dividend forecast for this year because of lower profitability, we still expect dividend yields to be around 8%, which is still quite attractive. And they are able to pay that because of its high net cash balance. And overall, the company is still trading about 8 to 9 times PE, which is not demanding. So as a result, we do think that it's actually good to hold on for the dividends and wait for a clearer outlook. And when orders start picking up again, then we may upgrade it to a buy going forward. And lastly, we'll move on to CSE Global. Basically, they reported order wins of 187 million for the third quarter this year, which was quite disappointing, but it's a 38% decline year-on-year. However, we understand that there was a few big off contracts secured last year that were just one-off, and then also there were some delays on certain projects which were worth 60 to 80 million, which will likely be delayed to be signed in the fourth quarter. So as a result, that's why the 3Q numbers for orders does look quite soft, but in actual fact, that may not be the case. And also, we do think that orders will likely pick up in the fourth quarter, especially with this 60 to 80 million coming in. Fourth quarter should likely be quite strong. And if you look at the overall momentum of electrification projects, it is still there. So we do think that the outlook going forward is still quite good for CSE. Next, if you look at revenue for 9 months 2024, it still picked up about 20% year-on-year, which is actually in line with our expectation. With a revenue growth of 20% and due to operating leverage, we do think that net margins will likely be higher this year than last year, which will result in stronger profitability. This is, of course, if you don't count in the $8 million settlement fee that you have to pay, the core earnings will still be quite strong. And without that, for next year, core earnings should actually still be stronger. And ending order book is still very healthy at about 600 million, just a 1% decrease year-on-year from last year, which we do expect orders to pick up in 4Q. Rightly so, ending orders should be healthier by 4Q this year. As a result, we still remain bullish on CSE's prospects, and we do think management will back up and deliver the performance that we need, that we expect going forward. So we'll end off with this. Basically, we also have an upcoming virtual meeting with CICT on the 5th of November. So remember to sign up for that. Thank you for your support. We will see you next Monday, and have a profitable trading week ahead.